Hey, welcome back to Father and Son Investing. It is almost 4 in the morning. I finished work a little while ago and I'm heading out this afternoon to go see a new grandson. So hopefully this video will be something coherent for you. Today's video is going to be the December 2023 Treasury Note and Treasury Bill update. Alright, today we're going to talk about factors that I see that say that the Treasury yields should still be up. I know that everyone is thinking that the Fed is about to start lowering rates sometime soon. Who knows when that would be? They're not saying anything yet about decreasing rates. Nevertheless, that's what the market is saying. But the things that I read and listen to and watch tell me that Treasury yields should still be up and not dropping like they are the last couple of weeks. So I'm going to give you the factors that I think that are saying no, Treasury bill yields should be staying high. Then I'll give you a little sneak peek at what Treasury note and bond yields may do in the next couple of years, coming from a Treasury expert. And then lastly, I'll give you my take or my strategy for Treasury notes and bonds for the month of December 2023. So let's get started. This really is kind of a good news, bad news here. We're just going to use the 10-year as an example, touching almost 5% on October 23rd. And now, a little bit more than a month later, we are down at around just a little shy of 4.3%. Well, what's the good news in here? The good news is if you purchased a bond back at the 5% level or so, well, your bond is worth even more than it was. The good news also is if you have bonds that were older that have much lower yields, well, then the price of your bond, those bonds are starting to sneak up. The bad news here is if you were looking to capture some of these 10-year Treasury notes at the 5% range, you really just had that one day to try to pull it off, because since then things have pretty much been coming down. It's that way with pretty much all of these, the 2-year, the 3-year, the 7-year, even the 30-year. So everything is coming down over the course of the last few weeks. Now all of that has wiped out the term premium that had developed over the past few months. Remember, the term premium is the little extra that one should expect for giving the government their money for a longer period of time. Locking it up for that longer period of time should earn one that term premium. It had turned positive back in August. That's no longer the case, and so that little bit has been wiped out, the term premium. So all of this just says, bond prices here are going up. And why is that happening? Because everyone is thinking that the Fed is going to be changing rates, lowering rates sometime soon. And potentially people also thinking that a recession is on the way. Nevertheless, despite all of that, I still see some things that are telling me that bond yields should be staying up. Here's one of them. Treasury's $39 billion auction of 7-year notes was poorly received, trader says. This was for the November 28th 7-year Treasury note auction. This article went on to say that the $39 billion auction was a fairly ugly auction based on where things were at 1 p.m. Eastern Time, with primary dealers taking a larger than usual chunk of the allocation. If you're not familiar with that, when the auction is done, essentially, the primary dealers get stuck having to take on whatever is left of that auction. And they took a bigger chunk, and that has been happening more frequently. How about this one, talking about the 2-year bond auction that also occurred this week. 2-year bond auction sees slump in foreign demand. Digging into the details on this one, it says there was $137.2 billion bid for $54 billion. That gives us a bid to cover ratio. Remember, that's this 137.2 divided by the 54. Bid to cover ratio is 2.54, and that was less than the 2.64 for the October auction. So that tells us that less money is being bid for these U.S. Treasuries. Certainly it's still enough to cover all of it, but these are indications that the demand is down. Let's also look here again about the primary dealers and what they had to take up for the 2-year. It says that they had to take up 18.76%. That was a percentage point up from October, and it's the highest since April. So these primary dealers are getting stuck with what's left over out of these auctions. And then lastly, in this article, foreign investors were also reluctant. According to the auction data, they got just 57.38%, and that was down from almost 67% the month previous. So we have this situation where The money being put in for these Treasury bills is shrinking. The bid to cover is going down. We have decreased demand going on, and we have these primary dealers getting stuck with a larger percentage of this. Now, I found out recently that there used to be approximately 60 of these primary dealers. These are large banking institutions or other big financial institutions that are required to bid on every U.S. Treasury auction. There used to be about 60 of them. That shrunk down to kind of the low double digits, and it's up to about 22 or so right now. If these primary dealers keep getting stuck with larger portions of the auction than they are used to, there's a decent chance that some of these are going to drop out. We've already seen that many of them have dropped out from when it used to be 60. If these primary dealers start shrinking in number, that's going to put more pressure on the remaining primary dealers to take up those treasuries, and as that happens, their liquidity starts to dry up because they're holding all of these treasuries that they really didn't intend to hold to begin with. Meanwhile, as the demand for these treasuries is getting smaller, the issuance is only going up. This is from the folks at Apollo. They're estimating treasury auction sizes in 2024 will increase on average 23% across the yield curve for Treasury notes and bonds. Look at how drastically this has gone up. The green here they show as 2013, but just look how 2018, a little bit before the pandemic, and then 2023 and 2024. The volume of these U.S. Treasuries is just enormous. And this is happening in a time when we are not actually in a recession. Nevertheless, we have almost a $2 trillion deficit running when we are not in a recession. I'll come back to that in a little bit. Let me give you reason number 3 for why I think that U.S. Treasury yields should still be high and not dropping. And that goes back to the press conference where Jay Powell indicated following the FOMC meeting at early November, that these yields, these increased yields in U.S. Treasuries, particularly at the longer end of the spectrum, the 10, 20, and 30 year, that those yields needed to be sustained because they were actually doing a lot of the work that the Fed might otherwise do by raising interest rates. And now we see that these yields aren't sustained. They're coming down, and they're coming down drastically. So according to Chairman Powell, that was going to be a necessity, or at least one of the key things that they would be looking at in terms of whether they would raise rates again for this coming meeting in December. Now, I think the consensus pretty much is that they're not going to be raising rates at this meeting in December unless there was some big surprise in inflation, and I don't think that's going to happen. In fact, if we turn to the Cleveland Fed's nowcast, if we go to the Federal Reserve Bank of Cleveland's website, they have an inflation nowcasting tool there where they kind of predict what the CPI and CPE reports will have to say. So they are predicting for the month of November that the month-over-month inflation will actually go down negative 0.01, and that the year-over-year inflation would be 3.04. All of those would be welcome to the market. I'm sure they're saying actually core CPI would be 4.06 as well. So if this rings true come December 12th when they release the CPI, then I don't think the Fed is going to be raising rates. If for some reason there was this unheard of surprise in the CPI, then certainly there's a good chance that the Fed will be raising rates. But I think the consensus is they're not raising, but they're not going to be lowering either for the month of December. All right, I want to move on to where rates could be going in the next couple of years when it comes to U.S. Treasuries. I want to show you a clip from part of a discussion that took place on a roundtable on CNBC. The person speaking is going to be Mike Santoli. He is one of CNBC's bond experts, and he had this to say.
Well, especially if you think, I look at my monthly charts, and if things move in a certain direction, if markets set up in a certain fashion, I do think 13% would be my 10-year call.
Yeah, why? What gets you to that number? Because that is a shocking.
Where's that number from?
No, it is a shocking number. What I do is I went back to 1980. 10-year note yields peaked just shy of 16% in September of '81, and I did some cycle updates. And if you look at, there's basically like a 6.5, 7-year cycle that could bring us into double-digit rates. What would be key there is we would need to close above 7% in the next 2 years.
So
And if that happens, it would signal the next move, which would be more aggressive.
That's technically, but fundamentally, what we'll call that?
Oh, that's easy. Just
200%
look towards government.
200 debt to GDP.
Yeah.
We got no way. We got to print so much money.
Military budget and servicing the debt right now, or fighting it out to see who's in the lead. Imagine what that's going to look like in 2 or 3 years.
Now that sounds very countercurrent to what is happening with the U.S. Treasury bond yields right now. Just what is it then that might drive those yields up to 7% within the next 2 years? Let's go back to the issuance and that topic that I mentioned about we're not currently in a recession. All right, let's go back to issuance. Again, here, this shows us the expected issuance for 2024 compared to the past. Now let's ask the question, if we do go into a recession and say unemployment ticks up to 5 or 6%, just imagine the number of increased jobless claims that will be happening and the amount of unemployment insurance that will be getting paid for those jobless claims. How much more money will the government need to borrow on top of the increased issuance that was already planned? And then imagine that there's going to be decreased taxes coming in because of that recession. And so now the government has this problem with decreased revenue, but increased borrowing having to go on. And then add on top of that the possibility that Congress would be wanting to provide some stimulus to help ease the problem of a recession. And so there goes even more money. Now, where's all that going to come from? More issuance. Either more issuance, well, definitely more issuance by the Treasury. Who's going to be buying all of this increased issuance? I've already showed you that the demand is decreasing both within and without the United States. So potentially that puts the Fed back into buying the debt, which of course is going to pump in a whole bunch more dollars into the system and drive up inflation, which certainly the Fed doesn't want to do. That kind of puts us back into that stagflation problem that they had in the 70s. So as I looked at all of this and I was discussing this with my wife, man, I felt really concerned about the potential future. And she was saying, you just need to let people know that. So there you go. There's my worry. Now, what's my strategy for the month of December? Well, my strategy is, these rates are still pretty good in comparison to what they have been in the last decade. And even at almost 3%, the 10-year Treasury note is still a pretty decent yield right there. So my strategy would be, hey, go ahead and buy some, but don't pump in everything thinking that rates are just going to be falling like crazy, because I think there is a decent chance, given the factors that I've discussed on this video, that Treasury yields could still come back up, have a little bounce there, because the Treasury is going to have to offer more yield to investors to get them to absorb all the issuance that they're going to want to put out. That's going to do it for today's video. Please give us a thumbs up if any of this was useful for you. If you totally disagree, or even if you just partially disagree, feel free to leave a note in the comments what you think about potential bond yields, both in the short term and in the long run. Until next time, enjoy your investing.